Hello and welcome to today's session on Universal Parallel Accounting, the next big thing. My name's Janet Salmon. I'm the Chief Product Owner for Management Accounting, and I work for SAP. And I think probably a few of you know me as an author within Espresso Tutorials. So what am I going to talk about? I'm going to take you basically on a journey from about 2015, when we introduced the Universal Journal, to 2022, when we introduced Universal Parallel Accounting for the first time. So Universal Parallel Accounting is something that was provided with initially in the public cloud in 2105, now for the first time for greenfield customers within on-premise 2022. And obviously going forward, there'll be some changes, so you can see my what's next chapter, what's coming in 2023 and beyond. So I'll start with the use cases for Universal Parallel Accounting. Why should this be of interest to you? What sort of organizations are we trying to address with this product? And then I'm going to walk you through all the different aspects of financial accounting, from asset accounting, overhead accounting, inventory accounting, production accounting, and finally to group valuation. And then I'm going to open up for questions later. So let's start with the Universal Journal. And I think most people are familiar with this slide or variants on it. So you'll remember back in 2015, we took the general ledger as our central structure. The clue's in the name, ledger-based, a way that all financial transactions are updated. And whereas in the past we had financial transactions that were updating separately into the fixed asset table, into the controlling table, into the material ledger table, into profitability analysis, with all the reconciliation effort of keeping all those different tables in sync, we moved them all into one place, into the general ledger, into what became the Universal Journal. And the idea was that the Universal Journal had all the relevant fields, whether it was about assets, whether it was about cost centers, whereas it's about WBS elements, whether it was about materials or all your COPA dimensions. They were all sitting in a single document within the general ledger. But in fact, what we didn't do at that time is we didn't make really fundamental changes to asset accounting, controlling, the material ledger. You still had a costing run or an allocation cycle or depreciation as you had before. And what we're trying to do now with the idea of Universal Parallel Accounting is to actually get rid of the differences in some of those applications and get everything to behave as though it was designed as one thing in the first place, so that fixed assets don't just become a part of the general ledger, but they also start to behave like the general ledger. So if the general ledger has 10 currencies, then fixed asset also supports 10 currencies. If the general ledger supports 3 ledgers, then asset accounting will also support 3 ledgers, instead of having depreciation areas and a mapping into the general ledger. The same with controlling. Controlling will learn not just to support things like cost centers, WBS elements, orders, and so on, but to be ledger-based rather than based on the version, and so on, all the way through the different applications. And the idea is that things behave harmoniously, so that we no longer have 2 currencies in controlling, 3 currencies in material ledger, 3 currencies in fixed asset, and up to 10 in the general ledger, which just ends up getting messy. But before I go into too much detail, I think it helps to think about the different applications and the different types of application. So if I think more financial accounting and more asset accounting, then I'm generally heavier on the requirements on the left-hand side of this picture. So compliance excellence. I'm going to have my local gaps. Pretty much every country that I'm working in is going to have its own gap. So if it's HGB for Germany, Swiss GAAP, whatever, each of those company codes is going to have its own gap associated with it. In many cases, we'll have different currencies. So in that example, I'm going to have euros in Germany, Swiss francs in Switzerland. As we start to go around the cycle, I'll also see other things that are different. So for example, fiscal years. If we're working in Europe, we typically do actually work with the calendar year. But as you get into some other countries, you'll find that you've got a legal requirement to have your fiscal year running from September to September, or April to April, or June to June. And all of this can drive the structure of the way you've cut your system. So I've encountered customers who, for example, cut their controlling areas based on the requirements for functional currencies, and then ended up with no controlling area currency, or who've cut their controlling areas based on the different calendars that they need to support. And again, not had this other strategic steering view that says I'm sitting in one controlling area, I have one common accounting principle, generally IFRS if you're European, I've got one calendar and a group currency, euros in this example. And I often think of this as kind of the squaring of the circle. You've got these two fundamentally different sets of requirements, which have driven system design over the years. So a lot of the customers that I've worked with, because I'm in the CO area, have been very strong on the right-hand side here. They've had a very strong corporate governance around the way they built their accounting model. And then if they've needed to do something different in India, they've had a special ledger or all sorts of manual postings going on to sort out the requirements in India. Other organizations have been very locally driven. They've been very driven by their individual requirements of the individual countries. And they then end up with a data warehouse on top, trying to get things into a common accounting structure, into common valuation principles with a common currency. And of course, that means they haven't got in their local system those corporate reporting requirements covered. So that's at the very high level. And I think it's easiest if you actually think of the map. So this map is vaguely fictional, but you can see that we've got the idea of a customer that's headquartered in Germany, no surprise there. And they've got a subsidiary in India. And of course, the subsidiary in India requires a different fiscal year variant from Germany, which has got the calendar year as its corporate requirement. And of course, if they were in Australia, they'd maybe have a different fiscal year variant again. And typically we'll find customers with 4 or 5 different fiscal year variants, depending on which countries they're operating in. If you then look at the other requirements, obviously I'm a product costing girl, for those of you who don't know me. For years, we've had this question, am I doing standard costs? Typically in Europe and the US, we'll do standard costs unless we're in one of those industries where we've got a requirement for actual costing. But as we get into Brazil, some of the other South American countries, also Turkey, used to be Russia, you have that requirement for actual costing. And we had challenges in the past. We had a business function that supported parallel accounting. It was called parallel cost of goods manufactured. But what that meant is that you were trying to do a costing run for Turkey and those countries that needed actual costing in the additional accounting principle, and you had some reduced scope for that COGM costing run. And now we're saying those costing runs are set up by ledger, so you really choose, am I doing actual costing for everybody in my leading ledger? Am I doing actual costing just in those countries that have a legal requirement for it? And if I'm doing group valuation, do I have a costing run that also works from the group perspective? Moving on, also, I talked about the functional currency and the way customers have often cut their controlling areas because of their functional currencies requirements. And it's no accident that Mexico is the example here. So we've got a customer that's headquartered in the US, in Germany. They've got a subsidiary in Mexico, but that subsidiary in Mexico is doing the lion's share of its trade with the US, so it has a requirement for functional currencies in dollars. And in the past, it actually ran out of currencies in CO because we only supported controlling area currency and object currency. And it had to make a call, if it was looking at things like group valuation, whether it was going to have a functional currency as its third currency or group valuation as its third currency. And I've had a lot of calls with customers over the years saying they need more. And then finally, why are we doing this as an organization? Remember that circle on the right, because what I really want is I want to be able to manage my international supply chain based on the consolidated cost of goods sold, consolidated margins that take the true costs across the entire supply chain, and allow me to make decisions that are based on the corporate view rather than for the transfer prices that India has used, the Indian subsidiary has used to sell its goods to Germany, or the South American subsidiary, for example. So if we try to bring those things into 4 use cases, the first one would be the idea for parallel valuations, not as a lot of people in product costing have known it in terms of legal, profit center, and group, but rather the idea of 2 different accounting principles used consistently across the whole value chain. And I think the easiest way to start thinking about this is actually to think about where are the differences in your typical value chain. So almost always your assets will be valuated differently depending on your accounting principle. We have a lot of globalization requirements around assets, and they'll drive the value that you're allowed to capitalize at the start, and then how you depreciate that asset over time. Also, typically in inventory valuation, you'll have different requirements as to how you do your balance sheet valuations, how you record your inventory at period close. Although what we've typically said historically is you want one standard cost, you're managing your business, your subsidiary sitting in India based on one standard cost. And what changes now is that we say, no, there's no such thing as one standard cost. There's a standard cost based on the assets, based on the cost center allocations and so on in that corporate accounting principle, so according to IFRS. And then there's a second standard cost potentially based on the asset valuation and the cost center allocations in those local accounting principles. And the idea is that that flows through the entire value chain. So it might start not just with the asset, but with how you actually make that asset. So if we've got a WBS element or the PM order, you've potentially got obviously material being consumed, you've got primary costs being posed to it, and activity allocations that might be different depending which accounting principle you're working to. And the idea that this then flows through the entire value chain. So you've got settlement rules where you can decide how much of those project costs would you like to capitalize as an asset, how much must be held back and treated as an operating expense. In an extreme case, you might even capitalize according to the one accounting principle, but not capitalize at all according to the other and post everything to a cost center. And then as that asset starts to depreciate, you haven't got one flow into controlling, but you've potentially got multiple, as many asset valuations as you've recorded in the general ledger will be flowing onto your cost center. As many flows as you have on your cost center, you'll be allocating to other cost centers, allocating potentially to margin analysis, and those production cost centers or consulting cost centers where you've actually got an activity allocation coming off that, you're going to have a separate rate for your machine hours according to the different accounting principles, or for your consulting hours according to the different accounting principles. And that in turn is going to drive how you value your production orders, how you value your WBS elements, anybody that's using that activity, and also the way that value flows into inventory, flows into your market segments as part of profitability analysis. So I think that's very powerful, and it's something that we didn't really support before. If you think back to how it used to be, you had things like depreciation areas in assets. To have as many as you like, you could see them in the Asset Explorer, and then you made a call going into controlling which one of them is, in German it was your kalkulatorische Abschreibung, your one cost accounting approach from asset accounting. Obviously, we opened that up with the parallel cost of goods manufactured, but we had breaks in that flow. So for example, the production order never had that parallel flow. We had the multiple flows on the cost center, and we had multiple flows in actual costing, but we had these breaks in the flow. And now the idea is that everybody, just like the Universal Journal brought together the fields from the different accounting applications into one table, now we're bringing the common approach, the idea of a ledger, common currencies, and the accounting principle across this value flow. The other big thing that would drive the way people split their controlling areas in the past was the idea of the alternative fiscal year. So what we support here is, in this example, 0L has got the group accounting principle. If it's IFRS, it's probably also going January to December, so the calendar fiscal year. But in Ledger 2L, we've got the local GAAP, where everything's working, in this case, from January is actually the 10th period and not the first period, and December is then the 9th period. And what this means in controlling terms is simply that when I do an allocation, if I do my allocation for March, it's period 3 in the group accounting principle, it's period 12 in the local accounting principle. But in terms of asset accounting, it becomes more complicated still, because that shift in the calendar in terms of which year does it belong to also affects how you capitalize an asset. So in this example, I've got an asset with 10 years of useful life, And if I acquire it on the 1st of January, then in the group accounting principle, I start counting from the first period of whatever fiscal year that is. And in the local gap, I've actually got an asset that I'm going to start capitalizing in the previous fiscal year, because January in the second accounting principle isn't actually the end, isn't the start of the new fiscal year, it's the 10th period of the previous fiscal year. And that's something that I think is very powerful and something that people couldn't do before. Something maybe more familiar, if you've worked with group valuation in the past, you'll be familiar with this idea of the consolidated view, where company code A sells to company code B at a transfer price, but there's a second valuation that says we're all friends and family, and I'm going to simply pass on the costs of the chocolate from company code A to company code B. Same at the intersection of B and C. Company code B sells to company code C at a markup, but in the other valuation, we're all friends and family. We've got an additional value for that cake that says these are the true costs across the value chain, and then there's the final sale to the customer. What changes in this view, if you worked with group valuation in the past, is you'll have worked with something called a currency and valuation profile. And that currency and valuation profile forced you to make a call and say, were you going to look at those true costs based on group currency, or were you going to look at it based on local currency? So the techie nerds amongst us will know it was 31 for group and 11 for local. And that same idea remains, but you don't have to make that call. Should it be 31 or should it be 11? In the new approach, you can have as many valuations as you need. So you can basically carry company code currency, group currency, functional currency, whatever you want, with that valuation idea attached. What also changes is we've been recommending throughout S/4HANA that group view should be treated as a part of a single valuation ledger. So essentially it was an extra column in the leading ledger. And we're now going to pull those values out of that extra column and make them part of the group view. So the group view being a separate ledger with the purpose of being a group valuation ledger. And something that we never had before. Essentially, our old approach was a cost-based approach where you were using the SD price conditions to pull the 10 euros for the chocolate or the 20 euros for the cake. And we still have that idea remaining, but what changes is those intercompany revenue and intercompany costs at those junctions are going to be eliminated. What you should know in addition is we've also got a new advanced intercompany stock transfer process and advanced intercompany sales process that are the basis for this. And if I go back to currencies, I said a lot of people ran out of currencies. I've had a lot of discussions with people who've been sitting there saying, well, I can only have 3 currencies in the material ledger. So should that third currency, if 10 and 30 are already spent, should that be 31 because I want to do group valuation? Or should it be an index currency or a functional currency? And I don't actually have enough in the material ledger and I need more. The idea with Universal Parallel Accounting is that FI works as before. So you still have the idea of a supplier invoice coming in or a general journal entry coming in, comes in the document currency, gets converted into company code currency, gets converted into group currency, gets converted into an additional currency. But what happens when we start to use those currencies is we treat each column separately. So I'm going to allocate in company code currency, I'm going to allocate in group currency, and I'm going to allocate in functional currency, rather than having a principal currency and then translating the result into the other currencies. And I seem to have been answering questions on that since about 2005, since the introduction of the new general ledger, because historically CO only had 2 currencies. So if I did an allocation in CO that impacted FI, I had my allocation in object currency and in controlling area currency. And then if I wanted a functional currency, I converted out of the other, which obviously isn't as accurate, brings inaccuracies. That third currency in FI wasn't actually very reliable if I was coming out of CO with only my 2 currencies. I've included some notes there because some of this was available before Universal Parallel Accounting, but not consistently. So if you're worried about that already in a project, have a look what you can already do with some of those earlier notes. So what does that mean? In simple terms, it means we're going ledger-based. So those of you sitting out there working with the account-based approach and Mickey Mouse and common accounts and accounts in the ears, time to move off that. We're very definitely working with a ledger-based approach. The ledgers keep some of the flags that we had before, so they keep the legal valuation versus group valuation view. I think it's really important to understand that the additional ledgers, you don't need an additional ledger for every single accounting principle you're supporting. You don't need 45 ledgers because you've got 45 accounting principles. The idea is that the company code is associated with an accounting principle. So in this example, you've got PAGB in Germany, PCG in France, and so on, all the way through the different company codes. And then you've got that common view in your new ledger, which is now separate for the group valuation. And what I'd like to show you now is how that looks in the system. So let's have a look at the ledger settings. I'm sure most of you are familiar with how to get in the IMG from financial accounting to the ledgers to the ledger settings. And I've talked a lot about currencies, so let's maybe start with the currency types. So we haven't lost the idea of +1, +2 being for the group valuation and the profit center valuation. You're still going to have 10 for the legal valuation, 11 for group valuation, and 12 for profit center valuation, or the same in group currency. So 30 for group currency, 31 for group currency and group valuation, 32 for group currency and profit center valuation. But what you see now is new currency types potentially appearing. So we've got 40 and 41 appearing. We've also got options for index-based currencies and so on. And of course, the ability to create your own currencies. And if we now look at the ledger settings per se, obviously there's all sorts of settings in this system, but let's look at 0L, which is our common ledger. If I swing, you can see it's in legal valuation. And the idea is that this is where all the company codes should be. You shouldn't have holes in this one. You've got 10 and 30 being used for every company code, and then additional currencies as you see fit. And you can see here they're all working with fiscal year variant K4. They're working with the calendar year and 4 special periods, and they're all working with the accounting principle IFRS. And if we now compare that with the situation in 2L, first glance, it looks similar. I've got all my company codes in there. I've got local currency 10, global currency 30. And if I move right, this is where things start to look different. Now, these aren't necessarily sensible settings, but you've got different fiscal year variants depending on the company code that I'm operating in. And I've got different accounting principles. So as I said, don't think that you need 45 different ledgers. You don't. You need one local valuation ledger with the different accounting principles in it. And then you've got the different fiscal year variants represented within that ledger. And then if I now look at 4G, it immediately looks different because instead of 10 and 30, I see 11 and 31. So I've got group valuation coming into play by default, and those are equal. There's no currency and valuation profile anymore. If you do a standard cost estimate to set your group costs, it's going to be available in both company and group currency, and any material movements that you make into company are going to be available in 11 and 31, and then any additional currencies that you choose to add. And if we move right, you'll see that they're all working with the corporate fiscal year variant, and they're all working with the corporate accounting principle. And now let's move on to the specifics of asset accounting. So obviously I can't cover everything that's in asset accounting, but think of the entire value flow from the creation of the asset, whether that's as an asset under construction, so you've got a project behind it where the costs are driving the value of that asset until you can finally capitalize it as a completed asset, or you're making a purchase of an asset and you're choosing, am I allowed to capitalize the freight costs or not, or can I only capitalize the actual purchase price of the asset, or you're doing a legacy update. All of those methods of acquiring an asset are going to be created with respect to a ledger. So as I do my asset settlement, my capitalization, I'm going to do that with respect to a ledger. And then any valuation and also the depreciation of things flow into CO are going to be based on a ledger. And of course, all of my reporting, all my closing operations, the first thing they're going to ask is which company code are you in and which ledger are you in? And you saw my configuration. Based on that configuration, they're going to be able to tell which fiscal year variant should I be using. Am I using K4? Have I got the calendar year plus 4 special periods? Or am I using one of those special calendar types? So what did that look like for an investment measure? The basic idea doesn't change. So I still have a WBS element being used to collect all the costs associated with that manufacturing process to build my asset. You've got the initial distribution role that says I'm asset under construction all the time that I'm being worked upon. And then when that asset under construction is completed, I do a full settlement to my final asset. And what I'll show you in the CO part is I can actually be more constructed there and actually go in and say, not just I've got to two distribution rules, but that distribution rule can reflect the ledger. So I might choose to capitalize a different amount as a fixed asset, depending which accounting principle I'm working to. And then as those values flow onto my asset values, you'll see here that I'm working within an asset, and you can see the ledger in there. The depreciation is still there. It's a real value. But you see how the idea of the asset accounting is being merged with the idea of the general ledger. And then the particular speciality of asset accounting is this idea of the post-capitalization. So I enter an asset transaction, I enter my posting date. In this example, I'm posting on the 1st of the 1st, 2023. And what the system does is it looks at the company code and it looks at the ledger, and it uses that to determine, based on the fiscal year, is the 1st of the 1st, 2023 actually the first period of my calendar year, which it is in Ledger 0L, or is it a not quite finished period or an earlier period in the earlier fiscal year in that company code FR00? And then it'll do the postings accordingly. As you move into asset depreciation, again, everything's going to take place based on the combination of the company code and the ledger. And it's based on that ledger that we'll get that flow into cost center accounting. So there's no mapping anymore from depreciation area to ledger in the general ledger, and from there into a version in CO. The ledger's there in asset accounting, it's there in financial accounting, and it's there in controlling. And we'll see that as we now go into controlling. So you see here the example again. I've got my WBS element. I'm creating an asset. I'm building an asset. I've got my settlement rule that says, is it an asset under construction or is it a final asset settlement? And then once the asset is operational, I can then start to depreciate it. And those multiple values will be reflected on the one hand in the settlement rule that says, how much of those costs on that WBS element am I allowed to capitalize? And how are those values going to then flow through depreciation onto my cost center? And once they're on my cost center, how am I going to allocate them to other cost centers? Or if I've got an activity in place because it's a manufacturing cost center or a consulting cost center or whatever, I've got the option, I don't have to, but I can have different activity rates depending on which accounting principle I'm working with. So I can either work with ledger blank and say machine time, it costs €100 an hour, whether it's IFRS or whether it's local GAAP, or I can make that distinction. And when it comes to the actual cost rate calculation, then I really do make the distinction. I look which values have I got in Ledger 0L or which ledgers have I got in Ledger 2L and calculate my rates accordingly. What that means behind the scenes is also we've got a different activity price table, but maybe let's start with the universal allocation. So those of you who've been viewing universal allocation slightly skeptically from afar and saying, yeah, it's all very pretty, but as you go into universal parallel accounting, the only way of allocating or doing a distribution or an assessment cycle or a top-down distribution to COPA or an allocation from your cost centers to COPA is to use the universal allocation. The idea being that this is the only one that supports the 10 currencies and the only one that supports the ledger. Of course, there are other advantages. You can see the nice allocation flow here, this graphical view of how the costs have flown from financials to purchasing or whatever the allocation rule said they should do. Again, what you've got, this is the idea of a flexible ledger. The idea here is that you've potentially got one structure that says this is how the costs are going to flow from sender to receiver. And you can define it once and then say everybody uses that same basic structure, or you can define ledger by ledger how you'd like the allocation to take place. Moving on to the cost rates, as I said, you've got a choice. You can either work with ledger blank, which means in this example, you've got 10 euros per hour, irrespective of which ledger you're in, or you choose to enter a specific ledger. So you enter 0L, which has a rate of 50 an hour, or 2L, which has a rate of 40 an hour. And whatever happens when you do the actual cost rate calculation, it'll separate and deliver you a value by ledger. The important thing here is we've got a new actual cost rate table. So a cost rate, AC for accounting, and then cost rate will replace our old friend table COST. So you won't be able to use KP26, the old transaction, to maintain your activity prices. You'll have to use the new Fiori. And I probably should have said that in asset accounting. The Fioris that we've shown are not just nice to have, they're something you must use as part of Universal Parallel Accounting. The other thing you'll see here is a new managed cost rates application that can be used in combination with this business function for intercompany. And the idea there is somebody like myself who's working in Germany, my consulting time could be charged differently depending on whether I'm working for SAP Sweden or SAP India or SAP Australia, depending on the rates that would be typical in that location. So I think that's also something quite powerful. The other thing always to be aware of, while I'm sounding like this is all the best thing since sliced bread, there's usually something that isn't finished. And in the case of the cost rates, it's the primary cost split that isn't finished. So there's no way to break out that cost rate and say those 50 euros for the activity rate in ledger 0L are made up of depreciation, labor, salary, and whatever. That's something that we're working on for the future. Moving on to settlement, I talked a little bit about that when I was talking about the investment measures in asset accounting. There's a new flag settlement profile that says I'm doing this with reference to the ledger, and also a new flag that says I'd like to have ledger distribution rules. In extreme case, that allows me to say in ledger 0L, I'd like everything to go to fixed asset, and in ledger 2L, I'd like everything to go to cost center. Of course, the more common use case would be in ledger 0L, 80% goes to fixed asset and 20% to cost center. And in 2L, it's something like 70-30 or whatever the split might be. And of course, what that means is settlement technically has to be started with reference to a ledger, and that ledger check will also check which calendar variant should I be using. But I really like this slide as a way of really saying what was the world like before, and often we just weren't conscious of it. So in this simple example, we've got two projects and they're both updating to asset under construction. And in ledger 0L, project A collects 75 euros and project B has 175, and we capitalize 175 as asset under construction. What was happening in ledger 2L was far less pretty. So what happened in ledger 2L is that I was posting my incoming costs. So those zero postings were different in ledger 2L. So I had 110 coming in to project A and I had 120 coming into project B. But what happened during settlement is that I was simply taking the values in the leading ledger and copying them into ledger 2L or whatever other additional ledgers I might have had, which meant that I had balances sitting around on project A or project B, which I had to manually clear, which didn't really tell me anything. And my value for my asset under construction in ledger 2L was not reliable at all. And if you look at the situation with Universal Parallel Accounting, I've got a balance zero in both of my ledgers, which is really what I want as an accountant. And I've got a correct value of my asset under construction, depending on the costs on the various projects and the various ledgers, which I think is very powerful. So now would like to go into inventory accounting and margin analysis. So the big change in inventory accounting is just as we've got a new price table for the cost rate, we've got a new price table for the material prices. So if you think of that picture, we've got different activity allocations flowing onto my production order, which means I've potentially got different values being used to update inventory. And this is something that if you use parallel cost of goods manufactured in the past, we still only had one standard cost. You still only had one legal valuation for your inventory, even if you might have had group valuation or profit center valuation active for your materials. And now you're saying, no, I've got an IFRS standard price and I've got a local GAAP standard price. And that's going to impact what happens when your cost of goods sold, when your goods issue is made to your market segments or to your customer, which is reflected in your market segments. And also when your goods are issued, if they're semi-finished goods to your production orders or projects or whatever the cost objects you are that you're using. So what does that mean? It means that we've now got a new price table. If you look in MM03, display material prices, the accounting view, all you'll see is the legal valuation. To actually see these different material prices, you're going to need to use a Fiori app. And that Fiori app will allow you to select, in this case for material TG10, I'm selecting based on ledger. I've also got an option you can see of selecting by valuation view. So I could select group valuation or legal valuation. Obviously, I'm also asking potentially for the relevant currency type. And I've got this idea of a future price, an inventory price, a standard price, and so on, which in business terms are familiar. We just didn't show them with respect to a type before. We support both standard and moving average price, so nothing really changes there. What you have to be careful, of course, is any manual adjustments you're doing, you really need to make sure you do them both with respect to a ledger. And then you've got uploads, whether you do this by API or by Excel upload. Again, you've got to be really careful that you're updating by ledger. But what's powerful about this, if you think about your group valuation or whatever, you've got this same idea of different prices depending on your accounting principle, different prices in group valuation, and the ability to have not just one price, but several based on the different currencies that you've got. So you've got the idea of having potentially 31, 11, and any other currency types alongside each other in that material price table. And of course, if we change the material price table, if you're manufacturing, if you're setting standard costs, you've got the option of either, like you did for the activity prices, saying that's actually way too much work and I don't think it's useful for me. I'm going to stick with my old costing variance, PPC1, doesn't know what a ledger is, it's going to update the same value into each ledger. Or you're going to differentiate and have a separate costing variant for each ledger. And obviously group valuation always had its own costing variant and its own settings. And you always updated that as a separate price. What that means at its simplest is you potentially got different values showing up in margin analysis. So in this example, the revenue is the same in both accounting principles, but you've got different standard prices, which drive different cost of goods sold, which in turn drive a different contribution margin, depending on the ledger. Now, all that really, the things you had to remember is that we had a ledger in play, that we potentially have different fiscal year variance. What changes with production accounting and with revenue accounting is you also potentially have a different approach altogether. And that different approach altogether is what we call the event-based approach. So most of you will be familiar with the idea that at period close, what we used to do was we would calculate the work in process, we would calculate variances if the order was finished, and then we would settle either the work in process or the variances to FI. So you had this two-stage process where you first calculated things in CO, and then you did a settlement to move those values into FI. And this gets absolutely turned on its head as you move into Universal Parallel Accounting, because we're doing it as we're going along. So obviously I create an order as before, nothing changes there. But as I issue my first raw materials to the order, those first raw materials are going to potentially kick off a material overhead if I've got a costing sheet in place, and the combination of that material cost plus the material overhead will give me a work in process value. The same thing as I do my order confirmation, I'm going to confirm 3 hours of machine time. That 3 hours of machine time is going to pull from the activity price table, depending on which ledger I've got an activity price. I'm then going to apply an overhead on top of that, and I'm going to calculate work in process for the combination of the activity plus the overhead. And that process is going to go on until I get my first partial goods receipt. And then I start reversing some of that work in process out. So if I've delivered half of my lot size, I reverse out half of my work in process, and I can start to calculate target costs. And that's going to continue until I get my final goods receipt or everything's technically completed, whereupon I'll clear all my work in process and I'll start to assign my variances to the various variance categories. So I'll be trying to say what's material price variance, what's quantity variance, what's the resource usage variance, and so on. There are still some gaps here, just as I said, for the activity price, that you couldn't have a cost component split. We don't yet support things like planned scrap or the valuation of actual scrap. We don't support mixed costing there yet. There's still quite a lot to do here, but I think it's a powerful story and it's a good start. Of course, there's an education element out there as well. Instead of having a task to do at period close, namely start all those CO transactions, the task is constantly to just be monitoring this, because what we do is we wouldn't stop the process if we weren't able to calculate work in process. We would write those material movements or confirmations into a log where we weren't able to calculate work in process or apply overhead. And the idea is that somebody should be monitoring those for errors, and if necessary, going back and configuring the customizing. Or if you did a manual journal entry to your production order, you might also want to kick off a manual work in process calculation to recognize that there's been a change to that order. But from a more ledger-based perspective, I think this view is powerful. So you can see again, you've got this double value in group gap of 1,490 and a value in local gap of 1,985. And that's exactly what you see as on the credit when my goods are delivered to inventory. I take the standard price in the group view of 1,490, and I take the standard price in local view of 1,985. And then if you look at how the actual costs stack up against that, my raw materials in this example have got a slight variance. My activities are taking place at standard, my overheads are taking place at standard. And that might actually be a very realistic thing. You could choose to keep your activity rates the same for the two valuations. You don't need to make a difference. But that difference in the material values has resulted in the total debit of my actual cost being 1,600 in my group accounting principle, and 2,150 in my local accounting principle, which means I've got different values to settle to reflect in my financial accounts. And I'm going to have potentially different values to explain those in terms of my various variance categories. And you've got to get away from this idea of settling. I know we've written settlement here, but in fact it's an immediate posting. Those variances will immediately result in a journal entry that updates not just the inventory, but also the various market segments. So you'll immediately see in margin analysis, these are the various variance categories. And I'm not going to attempt to explain this entire slide, but just as we have event-based work in process, results analysis won't be supported going forward. Instead, it'll be event-based revenue recognition. And you can see already there is a lot supported. So sales documents, projects, service documents, subscription business, and so on. There's a results analysis key sitting in those documents, telling the system how we expect it to behave in terms of revenue recognition. As a posting's made with respect to that sales document or with respect to that project or whatever, the system will look, is there a results analysis key in there? Oh, there is, so it's relevant for event-based revenue recognition. And then what method should I apply? So if I'm doing percentage of completion, it'll, for example, say, oh, you've received 100 euros of cost. We're expecting a 10% profit, so I'm going to realize 110 euros of revenue. In a different accounting principle, you might actually have a different method. You might be doing completed contract according to HGB. In that case, you'd say the 100 euros alone, I'm not allowed to realize as revenue. I'm going to treat that as work in process until I start to see the first revenues coming in. And if we look at group valuation, I used this slide initially just to indicate what was happening. The big takeaway from this slide, apart from the ledger idea, is that we've got these new intercompany sales and stock in transfer processes. If you haven't seen them before, the idea is that the sales order has a mirror sales order in the delivering company. There's a mirror purchase order in the selling company. And every time I do an outbound delivery, my cost of goods sold will be posted at arm's length in the legal valuation. But in the group valuation, that cost of goods sold will be removed. It'll be charged to a WAF-Konto in German, a price clearing account. The same with the intercompany invoice. The revenues will be posted and then they'll be eliminated. They'll be removed to this clearing account. And only when the goods reach the final destination will that revenue and that COGS be recognized. We'll also, as you can see, be using stock in transit, which isn't in itself new, but it gives a tidy ownership of who owns what when along that process. And then as you move the goods into the selling company, you'll get something that's more familiar as part of group valuation. Namely, you've got this at cost valuation where I'll be picking the standard costs for my goods and moving them into the next plant in the chain. In terms of what's next, the main thing that's missing is profit center valuation. So the idea that you've got an additional ledger for your profit center valuation, you've got profit center prices agreed between those profit centers. And what'll be changing is there'll be elimination postings, again, taking place where we cross companies. So from where profit center 1 sells to profit center 2, and I'm implicitly also crossing from company code 1 to company code 2. I've got a roadmap here, but I'm sure I'm actually going to get asked loads of questions about where we stand today and where we're going to be. The first question I'll say straight out, though, we do have transitional tools in planning. Those of you who started S/4HANA without Universal Parallel Accounting, but like what you see, there will be migration tools going forward, but it'll take us a while. And you can see we've got 2 steps there. The simplest approach coming in 2023, and the more complex one where we take things out of multiple valuation, move them into a separate valuation, coming in 2024 and beyond. And with that, I'd like to open up for questions. Thank you very much for listening.